Hello friends, I am CA Palak Pavagadi. I welcome you all on behalf of Navkar Institute, the digital platform for the online learning. This is direct tax law amendments applicable for May 2019, November 2019 examination. These amendments are made, friends, by Finance Act 2018. And what we are discussing is the analytical portion of the amendments. This is for final CA, as well as some portion would be applicable for intermediate as well as Ipcc also. Let us begin with the first portion, and the most important portion which is coming in is the tax rates. Friends, small changes are made in the tax rate. For the academic purpose it is small, but for the practical purpose it is quite big. For the individual HUF, including AOP, BOI, artificial judicial person, till last year, the tax slabs were up to rupees 2,50,000. It was no tax, basic exemption limit. Then 2,50,000 to 5 lakh, it was 10%. 5 lakh to 10 lakh, it was 20%. About 10 lakh, it was 30%. The tax slab is been revised for the small people, and they have provided that up to 2,50,000, the basic exemption limit would remain as it is. But between 2,50,000 to 5 lakh, the tax payable will be not at the rate of 10%, but the tax payable will be at the rate of 5%. So, those who are earning lesser income would be allowed a benefit. Even not only those who are earning lesser income is allowed the benefit. If you are earning 7 lakh rupee, then also between the bracket of 250 to 5 lakh, your tax rate will be only 5%. So, there is a benefit which has been given to almost all the assessees who are covered by the particular bracket, who are going above the exemption limit. Needless to mention, for senior citizen, the basic exemption limit is 3 lakh if he is resident, and for super senior citizen, the basic exemption limit is 5 lakh if he is resident. For the super senior citizen, this particular amendment would not have any impact. The same rate is applicable for Hindu undivided family also. A big benefit is allowed to the domestic company also, friends. To encourage the corporate form, government has come out saying that domestic company, your tax rate was 30%. You are aware that for partnership firm, limited liability partnership firm, the tax rate is 30%. For limited liability partnership and the partnership, the tax rate has been kept 30% only. But for domestic company, the tax rate is been reduced to 25%. But this 25% is very conditional. The tax of 25% is applicable in the previous year 18-19, subject to in the previous year 16-17, your turnover doesn't exceed 250 crore. See, the government is trying to give the benefit only to few companies. Those who are having turnover which is not exceeding 250 crore in the financial year 16-17 would be subjected to tax at the rate of 25% in the financial year 18-19. I know that there would be a question in your mind that why they are taking the base of the earlier year. See, previous year 16-17, it is not immediate preceding previous year, but it is not 17-18, but it is 16-17. The reason being the books of accounts of 16-17 would be ready. Books of accounts of 16-17 are perfectly audited by the auditor. It's been finalized by the auditor. And you can easily decide your tax rate from day one of financial year 18-19. If the government would have given previous year 17-18 turnover doesn't exceed 250, then first installment of advance tax, that is on 15 June, you are not aware whether it is going to be 25% or 30%, or you are in dilemma whether it's going to be 25% or 30%. Government wanted to avoid the same, and hence government has provided that you look at the turnover of previous year 16-17 for which the books of accounts are audited and finalized. If it doesn't exceed, turnover doesn't exceed 250 crore, your tax rate in the financial year 2018-19 will be 25% in place of 30%. Next, surcharge rates for domestic company are kept as it is, but for foreign company the surcharge rates are revised. The surcharge rate for the foreign company is up to 1 crore rupee net total income, there is not going to be any surcharge. But if the total income exceeds 1 crore, but if it doesn't exceed 10 crore, the surcharge will be 2% of tax. At the same time, if the total income of the foreign company exceeds 10 crore, the surcharge will be leviable at the rate of 5% on tax. All of you are aware that the rate of surcharge on the domestic company is 7% and 12%. All of you are aware that the rate of surcharge on individual HUF, AJP, AOP, BOI is 10%, 15%. Then the question may arise that why there is a less surcharge on the foreign company. Friends, there is less surcharge on foreign company. The reason being foreign company is taxable at a flat rate of 40% subject to DTAA, and that's the reason the surcharge rate is being kept lower. For individual HUF, AOP, BOI, artificial judicial person, the rate of surcharge is going to be, if your total income doesn't exceed 50 lakh, no surcharge. If your total income is above 50 lakh but up to 1 crore, the surcharge will be 10% of tax. And if your total income exceeds 1 crore, the surcharge will be at the rate of 15%. Look at the comparison. For the foreign company, if the total income exceeds 1 crore, the surcharge is only 2%. But here, if the total income exceeds 1 crore, the surcharge will be at the rate of 10%. The reason being tax rates of foreign company are lower. A major change in this says. Earlier, there was education says 2% of tax plus surcharge, and higher secondary education says of 1% of tax plus surcharge. Now, government has changed the same to health and education says. And there is a composite rate given of health and education says to be not 2 plus 1, 3%, but they have given the composite rate to be 4% of tax plus surcharge, if any, would be leviable as health and education says. So friends, there are major changes as far as the tax rates are concerned for the year 2018-19. After the tax rates, my first technical amendment is related to accumulated profit. If I take you to the base, friends, this accumulated profit is a concept which is relevant for the purpose of dividend. You all are aware that there is a concept of deemed dividend under section 222A, asset distributed by the company, 222B, debenture deposit or bonus given to the preference shareholder, 222C, asset distributed at the time of liquidation, 222D, anything given at the time of capital reduction, and 222E, the major one, that is loans and advances. Two fundamental changes are made as far as the concept of deemed dividend is concerned. The first doesn't affect much in the practicality. Second affects a lot in the practicality. The first one talks about the definition of accumulated profit. See, if there is a company which is distributing the asset to the shareholder having fair market value of 3 lakh rupees, and it has the accumulated profit of, say, for example, 10 lakh. The shareholding of this particular shareholder is only 22%. Then for 222A, one has to take 22% of 10 lakh, that is 220, or fair market value of asset distributed, whichever is less, is deemed dividend. Now, the question arises, how do you arrive at this 10 lakh? What is your accumulated profit? Friends, accumulated profit was defined in the Act as the profit of the company whether capitalized or not. Capitalized or not means whether in past the bonus is declared from the same or not declared from the same. If there is bonus declared from free profit in any of the past year, then such bonus declared would be added to the accumulated profit. Now, there is a case wherein X Limited is a vendor company, got amalgamated with Y Limited, and the dividend is declared by Y Limited or asset is distributed by Y Limited. Up to now, the provision was that the accumulated profit would be the profit of Y Limited only, whether capitalized or not. They've now clarified saying that your accumulated profit would include the profit of vendor company also, the profit of demerged company also, and hence your amount of accumulated profit would be higher. If your amount of accumulated profit would be higher, then you are not going to have any benefit. The government would be having any benefit over here. The reason being their accumulated profit proportion or percentage would be higher, and hence they would be able to charge more dividend distribution tax on the same. So now the accumulated profit will include the accumulated profit of vendor company also in the case of the purchasing company being an, or rather the company declaring dividend being an amalgamated company. Second, this doesn't affect much in the practicality. But as far as the second one is concerned, it affects in practicality like anything, and that is talking about the loan and advances. One of the most controversial area, friends, as far as the practicality is concerned, is the closely held company giving loan to the shareholder having substantial interest. Substantial interest here means 10% or more voting power on the date of the loan. Now, if the company is giving loan to the shareholder having substantial interest, then such loan, such advance would be considered as deemed dividend to the extent of the total accumulated profit of the company, including, as I have said earlier, the accumulated profit of the earlier company, vendor company, or the amount of loan, whichever is less. Up to financial year 17-18, the provision was that this 222E loan advance by closely held company was the only Indian company dividend which was taxable in the hands of shareholder. And shareholder has to pay the tax. Now, what used to happen, friends, in the practicality is that there is X Private Limited has given loan to the director Mr. A having substantial interest worth rupees 3 lakh. Now, this director is been assessed at X place, company is been assessed at Y place. Generally, the director and company is assessed in the same ward, but still there are lacunas as far as the procedural part is concerned. Now, this director's books of accounts was showing that he has received the loan of 3 lakh from X Limited. The officer of X Limited was not, X Private Limited was not much concerned and was not putting his efforts to find out 222E. Same way, even if the officer of director wants to, it was quite difficult for him in the hurry to complete the assessment to check out whether it is deemed dividend or not. And number of loans, number of advances were going untaxed. To overcome the same, it has been provided that from the current year, financial year 18-19, dividend under section 222E declared by the closely held company, loan advance given by the closely held company to the director having substantial interest is also subjected to dividend distribution tax by the company itself, and it would be exempt in the hands of shareholder. But there is a major change. The rate of DDT over here capped is not 15% as generally in others. The rate of DDT capped is 30%. In 222A, B, C, D, you have to gross up the dividend. Like if your dividend is 85, your DDT will be 15 and the total will come to 100. While here the methodology is not grossing up. Here if you are giving the loan of 100 rupee, the company is supposed to pay a DDT of 30 rupee. Here you don't have to gross up. You don't have to take 70 is to 30. You have to take 100 is to 30 as the DDT. So the major change is 222E, deemed dividend would now no more be taxable in the hands of shareholder. Company is supposed to pay DDT. The rate is 30% without grossing up. Second major one. You are aware that Mr. Jaitley in the earlier budget has said about section 115 BBDA. Section 115 BBDA talks about domestic company dividend. If any resident assessee other than the domestic company is receiving the dividend from other domestic company, even if the DDT is paid on the same, the aggregate dividend up to 10 lakh is exempt. But if the dividend exceeds 10 lakh, then the excess will be taxable at the rate of 10%. Now, this is applicable for the dividend covered as final dividend, interim dividend, dividend under section 222A, B, C and D. For calculating the limit of this 10 lakh, you are not supposed to include deemed dividend under section 222E. 222E is not going to be the part of this 115 BBDA. 222E would be fully exempt in the hands of shareholder. Why fully exempt in the hands of shareholder? Because on other dividend, the company is subjected to pay DDT at the rate of only 15%, while on 222E, company is supposed to pay the DDT at the rate of 30%, the higher rate, and hence, while computing the limit of 115 BBDA, this 222E is not included. Another measure. Sir, always try and understand the reason of the amendment and you will understand the amendment well. Reason of the provision and you will understand the provision well. There is general rule accepted in number of judgment which says that no one can earn by trading with himself, herself. Meaning thereby, we have been taught in accountancy that if proprietor is withdrawing the stock for his personal purpose, then it should be withdrawn at a cost price, and on this there should not be any taxability. Until now, this was very acceptable in income tax. People have started playing mischief. What mischief? I'll clarify. Assume one of my client is builder, and this builder is having the business of construction of flats and bungalows. He has got huge stock lying unsold, on which it's difficult for him to get the loan. So what he has done is, out of this stock, he transferred to his proprietorship or his individual name. There is nothing like on paper transfer. It was appearing as stock in his personal or in his balance sheet of business proprietorship, which is now transferred by him as his capital asset, which is to be kept for a longer period, and which is given as a collateral security to the bank for the purpose of getting the loan in the name of the director in his individual capacity. Builder is not getting finance on the stock in trade. So what builder has done is, builder has got the finance as LAP, loan against property, by converting the stock into the capital asset. And till last year, it was converted at cost to cost. There was no taxability. Mind well here, friends, that there is section 45(2). 45(2) talks about capital asset converted into stock in trade and thereafter sold off. But here the situation is not capital asset converted into stock in trade. Here the situation is stock in trade converted into capital asset, and till previous year 17-18 it was not taxable at all. From the current year it is provided that when the capital asset, or my mistake, when stock in trade is converted into capital asset, in the year of conversion, one has to compute and pay the tax. How to compute the tax? You have to take the cost of the stock in trade and you have to book this at the fair market value on the day when the stock in trade is converted into capital asset. And unlike 45(2), this would be taxable in the year in which the conversion has taken place. In 45(2), when you convert capital asset into stock in trade, you tax the same, you pay the tax in the year in which the asset is sold off. Here it is not. Here it would be taxable in the year in which conversion has taken place. And while computing the income under the head business profession, the fair market value is taken, as I have spoken earlier. Now, when you have converted your stock into the capital asset, you already paid the tax under the head business. When you sell off this capital asset, your cost will be the fair market value on the date of conversion. So there won't be any double taxation. And when you sell off the particular asset, your period of holding for the purpose of considering long-term, short-term would start from the date of conversion to the date of sale. Let us assume that I have got the stock in trade at a cost of 100 rupee. I converted the same into capital asset. On the date of conversion, the fair market value was 130. So 100 and 130, the difference will be 30 taxable as business income in the year of conversion. Now assume I have converted the same on 15th of July 2018 and I am selling it off on 3rd of November 2019. My capital asset I have sold off on 3rd November 2019. Then for the purpose of computing long-term, short-term, my period of holding will be 15 July 18 to 3rd November 19. At the same time, if I am selling it off at 148 rupees, my capital gain will be only between 148 and 130. That conversion FMV would be allowed as my cost so as to avoid the double taxation. And friends, here the changes are made for the same in the topic capital gain as well as for the topic business and profession 28. Change as far as 224 and 56(2)(11) is concerned. Friends, all of us are aware that if employee is asked to leave the job by the employer, or there is some modification in the contract of employee by the employer, then in this particular case, you are aware that if some compensation is paid by employer to employee, even if this compensation is a capital receipt, this compensation is taxable to employee under the head salary, under section 17(3) bracket Roman 1. It provides generally any amount received by the assessee from his employer or former employer at or in termination or modification of contract is taxable as salary. The words are by the assessee, from his employer or former employer. Look at the words, by the assessee, from his employer or former employer, at or in termination or modification of contract is taxable as salary. Friends, the change made is under section 56(2)(10), 73(1) has been kept as it is. Additional section 56(2)(11) is been inserted to provide that any compensation or any other payment due to or received by any person by whatever name called in connection with the termination or modification of the terms and conditions relating thereto, kindly pardon, is taxable in income from other source. Sir, this would be when the compensation is not able to be taxed under the head salary. Now, when the compensation is not able to be taxed under the head salary, when it is not received from the employer. You will say, okay, sir, former employer is also covered there. Agreed, former employer is also covered. But let us assume that if such termination, modification, compensation is received by the relative of the employee due to X, Y, Z reason, the argument forwarded by them was that we are not receiving it from our employer or former employer. We are the relative of the employee. We are receiving on behalf of employee. We should not be taxed under their salary. There is no mechanism for taxing it under their income from other source, so it should not be taxable to us at all. To overcome this particular controversy, it has been provided that 56(2)(11) is applicable and relatives you would be taxed under 56(2)(11). For salaried person, we have seen two fundamental planning. The first fundamental planning, friends, which we were making was medical perk visit, 15,000 rupees, bills of medicines, and almost all the companies are giving 15,000 rupees at medical reimbursement, which was not taxable at all till now. Second one was planning in the conveyance allowance, which was up to 1,600 rupee per month is exempted. So these were the two fundamental planning made by almost all the salary class people. Government said that this 1,600 multiplied by 12, 19,200 plus 15,000, 34,200, yeah, stop it. This is the planning which you are making. We are aware that these are not genuine reimbursement or this is not genuine allowance. To overcome the same, government has again reintroduced standard deduction under section 16(1)(a). The standard deduction of rupees, not the benefit which you were earlier getting, 34,200. You are given standard deduction of 40,000 or amount of salary, whichever is less is allowed while computing the income under the head salary. But at the same time, above is allowable as the following benefits are omitted from the topic salary. Number one is medical perk visit per annum, 15,000 rupees, and number two is 1,600 per month conveyance allowance. So, those who are genuine, who are ingenuine, are allowed 40,000 rupees maximum standard deduction from the topic salary. Sir, in effect, a major correction. Stamp duty value is a big subject matter of controversy. All of us are aware that under section 50C, if I am selling off my capital asset, being an immovable property, then my consideration to be computed as not the only sale value. My full value of consideration will be actual sales price or the stamp duty value, whichever is higher. There was a confusion, there was a controversy whether the stamp duty value is to be taken as on the date of sale deed or agreement to sale. Generally it is sale deed, but if agreement to sale is entered and any amount of consideration is received by any mode, which is account pay check, account pay draft, on or before the date of agreement to sale, you can take the stamp duty value as on the date of agreement to sale, is being clarified, is the provision. Now, for the small differences also, government was applying this 50C or 43C. I'm first targeting 50C. From the current year, Mr. Jaitley has given slight benefit. He provides that if stamp duty value is not more than 105% of the actual sales price, then assessee is allowed to take the actual sales price as the full value of consideration. If I clarify, my actual sales price being 10 lakh and my stamp duty value being 10 lakh 40,000. Till previous year 17, 18 we were taking 10 lakh 40,000 only and we were applying 50C. But from the current year, it has been provided that your actual sales price is 10 lakh, your stamp duty value is 10 lakh 40,000, which is less than 105% of actual sales price. Forget about 10 lakh 40,000, take only 10 lakh. But if your actual sales price is 10 lakh and your stamp duty value is 10 lakh 60,000, you are supposed to take into account 10 lakh 60,000. If it is more than 105% of actual sales price, one has to take the stamp duty value. If one is taking the stamp duty value, obviously you are aware that the portion related to inviting the valuation officer and other stories would arise. Same mechanism is there under section 43CA for the builder who is selling of his stock in trade. For builder also, when he is selling of the stock in trade, his consideration will be actual sales price or stamp duty value, whichever is higher. Here also, if the stamp duty value doesn't exceed 105% of the actual sales price, one has to take actual sales price only. And the most important, gift. If someone is giving me the gift of a building and I am paying him 20 lakh, the stamp duty value of this particular building is 23 lakh. Then you are aware the difference between 23 lakh stamp duty value and amount I have paid 20 lakh, that 3 lakh rupees that gift to me, taxable under section 56(2)(10), subject to it is not received from the relative. Here also there has been a relaxation. From financial year 18-19, government says that gift will be taxable only if difference between the stamp duty value and the actual sales price exceeds 50,000. That condition remains as it is, which was there last year. Plus, government has said that if my payment made by me is 20 lakh and the stamp duty value of this property is 20 lakh 80,000, stamp duty value 2080 doesn't exceed 105% of actual price paid by me, that is 20 lakh, there is no taxability of gift. Even if, friends, you see the difference between 2080 and 20 is 80,000, which is exceeding 50,000. Now, there would be two limits applicable. The gift will be taxable under that other source only if the difference between actual price paid and stamp duty value exceeds 105 and the difference exceeds 50,000. Either of the two conditions being not fulfilled, section 56(2)(10) is not going to come into play. A small amendment, very rarely applicable for intermediate, but still I am highlighting. Final C always applicable. There is a concept of speculation business. Friends, the question arises, what is speculation business? Speculation business is normally defined under section 43(5) as the, rather not business is defined, speculation transaction is defined under section 43(5) as the transaction of purchase or sale of goods, commodity, which is settled otherwise than actual delivery thereof. Now, we all are aware that in derivative transaction, future, option, forward contract, we never take the delivery. Stock market, if I talk, intraday we don't take delivery, but intraday will be speculation. Friends, for derivative, be it be stock derivative or be it be commodity derivative, there is a very specific exception given in the speculation transaction, that if there is derivative transaction, be it be stock derivative or be it be commodity derivative, this derivative transaction, even if delivery is not taken, won't be called speculation and it would be called normal only. All this story is important. The reason being, you people are aware, friends, that speculation loss can't be set off against the business loss. If there is business loss, it can be set off against business income as well as speculation income. If there is speculation loss, it would be carried forward only for 4 years. If it is business loss, it can be carried forward for 8 years, both subject to in-time return. Now, even if the delivery is not taken in stock derivative or commodity derivative, it won't be considered as speculation, it would be considered as business only. It would be considered as normal business only. Before few years, the Honorable Finance Minister brought in the condition that for commodity derivative, one of the conditions to be fulfilled for the purpose of calling it normal business is the commodity transaction tax must be paid. If CTT is paid, then only commodity derivative, even if no delivery, will be normal. For stock derivative, he came out saying STT must be paid. So, if we concentrate on commodity derivative, even if no delivery, it would be normal subject to CTT is paid. Thereafter, our Honorable Finance Minister sir said, no CTT is payable on agricultural commodity. Now the problem is, if you are dealing in agricultural derivative, CTT is not payable as per the law. If CTT is not payable, you have done commodity agricultural derivative. My Income Tax Act says that commodity derivative will be normal only if CTT is paid, and because of that, my agricultural commodity derivative was becoming speculative as CTT is not required to be paid and hence not paid. There was definitely a lacuna between the law income tax and the law CTT, and to overcome the same, it has been current year provided that if there is commodity derivative, then even if transaction is settled without delivery, it would be considered as non-speculative if the CTT is not paid. Friends, even if the CTT is not paid, it would be considered as non-speculative and there would not be any problem in setting off against the normal business. So, this is a clarificatory amendment, a welcome amendment. Those who are into the goods transport business, 44AE, presumptive tax system. This all presumptive, I would say that are favorite of Mr. Jaitley. The reason being, every now and then he is making some or other change in the presumptive 44AD, 8%, 6%, 44ADA for specified profession, and now some change in the goods carriage business. Section 44AE is applicable to those who are into plying, hiring, leasing goods carriage, and it's a presumptive tax system. The assessee is allowed to presume his income and profit on gain from each goods carriage to be computed at 7,500 rupee per month or part thereof, for which the trucks are owned by the assessee, was the rule till now. Financial year 17-18, they have bifurcated the trucks into two. Actually, this was the bifurcation, friends, earlier, heavy goods vehicle and other vehicle. There was taxability at different rate. But Mr. Jaitley again brought back the old provision of heavy good vehicle with some different methodology of computing or presuming the income. He said that profit and gain from each goods carriage to be computed as under, for heavy goods vehicle, ₹1,000 per ton of gross weight or unladen weight, as the case may be, for every month or part of month for which the vehicle is owned by the assessee. Sir, from 7,500 rupee per month or part of month, he is not saying flat 7,500 rupee. He talks about 1,000 rupees per ton of gross vehicle weight. What you are loading in your vehicle is irrelevant. What is relevant is what is the capacity of your vehicle. the maximum capacity, the registration from the RTO of your vehicle. On that basis, 1000 rupee per ton of gross vehicle weight is to be taken as income per month or part thereof. And for other vehicle, the provision remains as it is, and that is 7500 rupee per month or part of month for which the vehicle is owned by the assessee. The question arises, what is heavy goods vehicle? The heavy goods vehicle means any goods carriage, the gross vehicle weight of which exceeds 12,000 kilogram. 12,000 kilogram means 12 tons. I am repeating, 12,000 kilogram means 12 tons. Now, if you have 3 heavy goods vehicle of 15,000 kilogram and 4 other vehicle, then 15,000 kilogram is equivalent to 15 tons. You have to compute your income to be 1000 multiplied by 15, 15,000 rupee per month for 3 trucks or part thereof. And for another 4 other trucks, you have to take 7500 rupee per month or part thereof. The computation mechanism has been changed. For heavy goods vehicle, now there would be more taxability. If we check out, for heavy goods vehicle, there would be minimum taxability of 12,000 rupee per month. How come 12,000 per month? Heavy good vehicle means the cargo exceeds 12,000 kilogram. If the cargo exceeds or the capacity of the truck exceeds 12,000 kilogram, say assume it is say 12,001, then also 1000 rupee per ton will give you minimum 12,000 rupees per month or part thereof. So, he has increased the taxability for the heavy goods vehicle. 54 EC bonds. This was introduced by Mr. Yashwant Sinha in Atal Bihari Vajpayee government, and this was to encourage assessee to make investment in the government bonds like National Highway Authority of India or Rural Electrification Corporation. At that time, the scenario was people were not investing in NHAI, people were not investing in REC, government was not getting money, NHAI, REC was not getting money, and they were not able to develop the highway, National Highway Authority of India, and REC was not able to generate electricity in the rural area. Now, government has huge fund as far as this NHAI and REC is concerned, in NHAI and REC is concerned. And that's the reason slowly and gradually government is coming out some or other the amendments in 54 EC. Like earlier government brought only 50 lakh, then government brought 50 lakh aggregate in the previous year in which the capital asset or assets are sold, and the immediate the succeeding previous year. All these amendments are made earlier. This is to restrict the investment in NHAI REC. This year, a fundamental change. What used to happen up to previous year 17-18 was, I am selling off my jewelry, I am selling off gold, I am selling off diamond, I am having huge capital gain, say worth 30 lakh. And what I do is I invest in NHAI bonds. I used to enjoy exemption. And I was investing in the bonds of NHAI. The lock-in period on this particular bond was only 3 years. From the current year, government has said that this exemption is available only on long-term capital asset being immovable property only. This won't be available now on gold, silver, shares, unlisted or any other shares. No other assets, only available on immovable property sold. Previous year 18-19 onwards this talks about. So, land building sold long term, this would be available. Same way, the lock-in period is also been increased from 3 years to 5 years. You have to keep these bonds with you. You cannot sell, you cannot mortgage and take the loan up to 5 years from the date of acquisition. Then only the exemption of 54 EC would be available. In nutshell, if we read the section, it goes this way. Any assessee selling of long-term capital asset being immovable property and making investment in the bonds of NHAI, RE or any other specified bonds, within a period of 6 months from the date of transfer, the capital gain is going to be exempt to the extent the investment is made, subject to the investment cannot exceed 50 lakh in the previous year and the immediate succeeding previous year. There is a lock-in period of 5 years in place of 3 years. Both the changes made in 54 EC is restricting the investment in the bonds of NHAI REC. Friends, honestly speaking, the rate of interest on NHAI REC is so low that if your client can afford to pay the income tax at the rate of 20% and invest remaining 80% amount somewhere else, then also he would be at a benefit if on 80% amount he is getting good return on investment. So as of today, these bonds are not much advisable in practicality. Friends, the biggest confusion as far as the particular provision is concerned, and I would be humbly requesting my friends of intermediate, my friends of final CA, please, whenever some new provision comes, refer it from the act, refer it from the bill if it is new. If it is some, say for example, new circular has come, notification has come, then read the circular, read the notification. Please avoid WhatsApp. Please avoid the social media as far as these legal provisions are concerned. This was one of the most, I would say, badly interpreted section after 1st February 2018, that is the date of the budget. Section 80 AC says that filing of return in time is compulsory if you wish to enjoy the general deduction. Friends, I would be honest saying that till financial year 17-18, if you wish to avail the deduction under section 80 IA, IB, IC, ID, IE, IBA, IAC, all this income side deduction, then it was obviously compulsory for you to file the return in time. It was there. In current year, Finance Act 2018, Mr. Jaitley has said on 1st February 2018 that for the purpose of claiming general deduction under chapter 6A, part C, I am very specific, part C, then one has to file the return of income well in time. He is very clear with part C, and we have interpreted the whole topic of general deduction. Here, general deduction has been divided into two parts, or rather 4 parts, I would say. Part 1 is general in nature, that is part A. Part B, expenditure side. Part B, expenditure side. Part C is certain income side deduction. And last 80 TTA, 80 TTB are part CA, if I am not mistaken. It is not in the part C. Many people have started messaging, started WhatsApp, that if you want to claim LIC PPF, a big blow, a hidden bomb, and what not. Yaar, read the provision. Act is very clear. Deduction in part C of the same chapter, that is chapter 6A, is allowed only if return of income is filed in time under section 139(1). This deduction would cover a deduction starting from 80H abolished to 80TT. 80TT, that would cover 80H, 80J, 80JJA. It would cover 80I series, IA, IB, IC, which was there, which is now there, 80 QQB, 80 RRB, all covered. 80 TTA तक covered है. After, sorry, 80 TT तक covered है. 80 TTA, saving interest. 80 TTB, FD interest I am covering now, which is amended. 80 U, that is disability, own disability, physical mental. For these 3, you are not required to file return in time. Even if you have not filed the return in time, you will be able to get the deduction. All expenditure side, investment side, LIC, PPF, Mediclaim, general deduction, donation, all would be available even if you file the return late. See, I don't encourage you to file the return late, but I want to convey you that even if you file the return late, you would be able to enjoy the deduction except 80H to 80TT. Certain small changes as far as general deduction is concerned. We people are aware that section 80D is available if medical insurance premium is paid. The deduction available for the HUF will be maximum 25,000 rupees. Extra 5,000 was available if the premium is paid by HUF for the member who is senior citizen resident. So, if it is paid for senior citizen resident, effectively it was 25 plus 5 would be 30,000. Same way, for an individual, himself, spouse and dependent children, it is 25 plus 5. If it is paid for parents, dependent, independent, it was again 25 plus 5. from the current year, this plus 5 has been increased to plus 25. Meaning thereby, if I am paying the premium for myself, my spouse and my dependent children, my maximum deduction available will be 25,000. No one of us is senior citizen. If I pay it for my parents who are senior citizen, then till last year I was getting the maximum deduction for parents worth 30,000, they being senior citizen. Current year I would be able to get maximum deduction for parents worth 50,000 rupees, a major change for the senior citizen. Till last year, the rule was, if a person is of the age of 80 years and above, for whom the insurance is not taken and medical treatment expenditure is incurred, such medical treatment expenditure is eligible for deduction under section 80D. Any sort of medical treatment expenditure, I am not talking about medical treatment of specified disease, any sort of medical treatment expenditure, subject to he is seniors, sorry my mistake, super senior citizen resident 80 years and above, and for whom medical insurance premium is not been paid. From the current year, this particular benefit is extended to senior citizen resident also. And friends, a very welcome provision. The reason being, there are number of problems for getting insurance of senior citizen. Many medical insurance companies are not giving insurance for senior citizen. So assume that I am not able to take the insurance for my parents who are senior citizen. I am not paying any medical insurance premium for that, and some medical treatment expenditure is incurred for my parents, then I will be able to get the deduction of maximum 50,000 for this medical treatment expenditure. Friends, if I highlight the provision, I have taken medical insurance for myself, my wife, my daughter, and I am paying 23,000 rupees premium. The premium is paid by me by any mode other than cash. I would be able to get 23,000 rupee deductible. For my mother, I could get the medical insurance premium. I could get the medical insurance and I am paying medical insurance premium of say 12,000 rupees. My mother is senior citizen resident. For my father, I could not get the medical insurance, as no insurance company is ready to offer me the medical insurance, as his age is say about 70 years. 12,000 is paid for my mother by me by any mode other than cash. For father, no medical insurance premium is paid by me. Now, for the medical treatment of my father, I have incurred 40,000, and medical treatment of my mother, I have incurred 60,000 other than what is been reimbursed by insurance company. For father, I would be able to get 40,000 rupee deductible under section 80D. Why I will be able to get it deductible under section 80D? My father is senior citizen resident. For my father, medical insurance is not taken. For my mother, I am paying medical insurance premium of 12,000. So I will be able to get 80D on 12,000, but I will not be able to get 80D on that 6,000, which is expended by me. Why I will not be able to get 80D of 6,000 on this 6,000? The reason being, one of the conditions for getting medical treatment expenditure deductible under section 80D is medical insurance premium is not paid for senior citizen resident. So father 40,000 treatment expenditure, mother only 12,000 insurance, aggregate comes to 52,000. I will be able to get not 52, I will be able to get only 50,000. Meaning thereby, मुझे मेरी wife का मेरी dependent daughter का मिला 23, parents का मिला 50. My aggregate deduction under section 80D will be 73,000. This is one. Second, sir, old days it was insurance for 12 months. Nowadays, many medical insurance companies are offering the medical insurance wherein you need to make the premium payment in lump sum, and you pay the premium in lump sum. It is for 3 years, it is for 2 years, it is for 2.5 years. General rule in general deduction topic is deductions are allowed on payment basis, outgoing basis. It's not due basis. But there was an issue wherein I am paying medical insurance premium of me, my wife and my dependent daughter worth say 60,000 for 3 years in the current year, and I am getting only out of 60, 25,000. Remaining I have to forget. Next year I have not paid anything, I will not get any deduction. To overcome the same, government has said that if you have paid 60,000 for 3 years, appropriate fraction will be allowed every year. That means I will be able to get 20,000, 20,000, 20,000 over 3 years. It would be allowed ऑन ड्यू बेसिस, वो प्रीपेड वाला आप यहाँ पे भी कर सकते हो. सेकेंड, ATDDB, a small change. This ATDDB is for the medical treatment expenditure of specified disease, dangerous disease like neuro disease या cancer या AIDS या say for example you have some other dangerous disease defined in Rule 60. If the treatment expenditure is incurred and you are able to get the certificate of the specialist in Form 10I, you would be able to get deduction under Section 80DDB. Till last year, the deduction was 40,000 rupees or actual expenditure, whichever is less. But if the expenditure is incurred for senior citizen resident, then you are eligible to get extra 20,000 rupees. From the current year, it has been provided that if the expenditure is incurred for senior citizen resident, extra 29, extra 60,000 is available, so that maximum deduction will be 40,000. Or if the expenditure is for senior citizen, maximum deduction available will be 1 lakh. And the major one over here is for senior citizen resident, there is a deduction on FD interest, deposit interest. 80TTB, mind well, you will be able to get 80TTA, 80TTB even if you file the return after due date under Section 139(1). 80TTB talks about the deduction available to senior citizen resident, subject to senior citizen residents are earning the interest from the deposit with banking company, cooperative bank or post office, and the deduction available to them will be actual interest or 50,000, whichever is less. They will be able to get maximum 50,000. Now, for me, for you, for non-senior citizen, we have 80TTA. You will say that, sir, 80TTA is there only also for senior citizen resident on the saving bank interest. Agreed, it's there. But it has been clarificatory provided in 80TTB that when you are claiming 80TTB, sorry senior citizen, you won't be able to get 80TTA. So, TTB can be claimed by senior citizen resident. If senior citizen resident has FD interest worth 52,000 and saving interest worth 15,000, 52 and 15 both are taxable under their other source. Senior citizen resident would be able to claim 80TTB worth 50,000 but won't be able to claim TTA worth 10,000. Both the sections cannot go simultaneously. It cannot come together is the provision proper, friends. So, this is from the general deduction. Another one is a deduction for encouraging employment. This section is drastically changed by the BJP government. Earlier the fundamentals were different, now the fundamentals are thoroughly different and some or other changes are being made over here. 80JJAA, they are the deduction for new employee. This deduction is available for the employment of new employees in the business. Mind well, would remind you that one of the conditions for getting this particular deduction is that assessee claiming the deduction must be covered by tax audit under Section 44AB of the Income Tax Act. Friends, this deduction is available for new employee. Certain conditions are there that the employee must be covered by PF, contribution must not be made by government, he is getting the emoluments not exceeding 25,000 rupees per month, the payment must be made by any mode other than cash or maybe made by account pay, check. All these conditions are there. But one of the crucial conditions is that you would be able to get the deduction for employee if they are employed during the particular previous year. For new employee, they would be called new employee and eligible for deduction only if they are employed for 240 days or 150 days or more during the particular previous year. Now, there are two limits, 150 and 240. This limit of 150 is for those who are in the business of the manufacturing of apparel or leather items business. 240 is for all other businesses. Assume that I have employed an employee in the financial year 18-19 in the month of, say, January 1st, on 1st January 2019. He is said to be employed for approximately 90 days. If he is employed for 90 days for the year 18-19, he is not eligible for the deduction. Now, if he is not eligible for deduction in the year 18-19, I have to lose the deduction for this employee from my business in the subsequent year also. Why? Because I will be able to get the deduction only if I am increasing the number of employee in the current year. 18-19, I have increased the number of employee, but 18-19, the increase is not for 150 or 240 days, as the case may be. I will lose the deduction in the year 18-19, even 19-20 onwards also I will not be able to get the deduction. Friends, Finance Act 2018 has provided that if employees are employed in one previous year for less than 240-150 days, you won't be able to get the deduction in that particular previous year. But if they are employed for 240 days or 150 days or more, in the immediate succeeding previous year, 18-19 I have employed them on 1st January 2019, 18-19 I will not be able to get the deduction. But if they are employed for the whole year, 19-20 previous year, then they are said to be employed in the immediate succeeding previous year, and then the deduction would be available from immediate succeeding previous year also. Why? You should be at disadvantage. Employ the employee in the month of January 2019, no worries at all. If you are employing the employee in January 2019, you won't be able to get any deduction in the year 18-19, but you would not be deprived from the deduction in the year 19-20. ये amendment नहीं लाते ना, तो what people would have done, what businessmen would have done, they would have asked the employee, January में मत आओ भाई, आप 18-19 में भी eligible नहीं होगे, 19-20 में भी eligible नहीं होगे. I'll employ you from 1st April. They will defer the employment. If they are employed directly from 1st April 2019, they are called new employee for 19-20, 19-20, 20-21, 21-22. For 3 years, this deduction is available at 30% of the emoluments. To overcome the deferment of giving the employment, to encourage the employment, quick generation of employment, it has been provided that 18-19 you won't get, but 19-20 onwards you would be able to avail the benefit. So, this is related to ATJJ AA deduction for the new employees. The next provision is related to section 1038 and 111A, which was for the long-term capital gain and short-term capital gain respectively on listed equity shares or equity-oriented fund if STT is paid. Friends, this provision was most discussed, debated prior to budget and after the budget. The history, if we go, this particular provision, section 1038, is inserted by the then finance minister of the UPA government, Mr. P. Chidambaram, in the year 2004. He said that on or after 1/10/2004, if you are selling off listed equity shares or equity-oriented fund on which if you pay the STT, then your long-term capital gain will be fully exempt. And short-term capital gain is taxable at a rate of 15% under section 111A. This was to encourage the genuine investor in the stock market through a recognized stock exchange. Then in the year 2017, the amendment has been brought in by Mr. Arun Jaitley said, for listed equity shares, section 1038 is available only if STT is paid at the time of purchase as well as sale. For listed equity oriented fund, section 1038 is available only if STT is paid at the time of sale. 111A is available on listed equity shares and equity oriented fund if STT is paid at the time of sale. Khali section 1038 में condition लाए that for the purpose of availing exemption of long-term capital gain, section 1038 STT must be paid at the time of buy as well as sale. Obviously, there are certain exceptions given in the legislature, like purchase prior to 1/10/2004, wherein STT was not applicable, or purchased in IPO, or purchased by way of bonus issue, or purchased by way of preferential allotment, or purchased by way of ESOP. All these are kept as in the proviso that even if STT is not paid at the time of purchase, section 1038 is available. Now, as we all are aware, in section 1038, the amendment brought in the year 2017 was just to curb the evil of that penny stock companies, which were being identified by the government, and government said that now no more exemption if STT is not paid at the time of purchase. A big blow to the stock market, and friends, we are aware that from that very day the stock market is struggling to settle down. Proviso 4 to Section 1038 is inserted by Mr. Jaitley, which provides that nothing contained in this clause shall apply to any income arising from the transfer of long-term capital asset being in equity shares in a company or a unit of equity-oriented fund or unit of a business trust made on or after 1/4/2018. Sir, in a simple language, if I say Section 1038 is no longer applicable from financial year 18-19, make the sale of long-term equity shares, equity-oriented fund listed. Even if STT is paid, the long-term capital gain is not exempt under Section 1038. Mind well, friends, 111A has been capped as it is. Exemption of long-term capital gain is not available, and you have to take all these listed equity shares. STT is paid on purchase as well as sale. Listed equity oriented fund, STT is paid on sale, both being long-term under Section 112A. The new section is been inserted, 112A. 112A goes this way. It provides, notwithstanding anything contained under Section 112, 112 talks about normal tax payable. The tax payable by an assessee on his total income shall be determined in accordance with the provision of subsection 2. If the total income chargeable under the head capital gain and capital gain is arising from the transfer of long-term capital asset being equity shares in a company or unit of equity-oriented fund or a unit of business trust, and STT is paid in the case of equity shares on acquisition and transfer. Mind well, on equity shares, STT is paid on acquisition as well as transfer. If STT is not paid at the time of acquisition on the listed equity shares, 112A would not be applicable. Normal capital gain tax will be applicable. STT is paid on listed equity shares at the time of acquisition and transfer, and in the case of equity oriented fund or units of business trust, STT is paid only at the time of transfer. The tax payable by the assessee on the total income referred to in subsection 1 shall be 1. The amount of income tax calculated on such long-term capital gain exceeding 1 lakh at the rate of 10%. The amount of income tax payable on the balance amount of total income as if such balance amount were the total income of the assessee. If I interpret this legal words of the law, sir, a major blow. If I have listed equity shares of Infosys, I have sold in the year 17-18 long term, it would have been exempted. But I have sold in the year 18-19, it is not exempt. Compute the capital gain as per the next slide. If I have TCS, compute the capital gain long term as per next slide. If I have Reliance, compute capital gain as per next slide. And in the financial year 18-19, make the total of computed long-term capital gain on listed equity shares, equity-oriented fund, units of business trust. Up to 1 lakh, you are not subjected to tax. Balance, you are liable for tax only at the rate of 10%. Mind well, छोटे-छोटे लोगों को इससे कोई परेशानी होने वाली नहीं है. Small people would not be at disadvantage by this. But those who are having a huge long-term capital gain, up to 1 lakh don't pay tax. If your long-term capital gain on TCS 70, Infosys 20, Reliance 30, 70, 20, 30, the aggregate is coming to 1,20,000. On the 1 lakh, there is no tax. On 20,000, there is going to be a tax at the rate of 10% under Section 112A of the Income Tax Act. Friends, but if I am a small investor and I have sold off long-term listed equity shares on which I have my capital gain worth 30,000 and 32,000, total comes to 62,000, I am still not liable for any tax. No, it is not exempt under 1038. Mind well, this would help me when I merge this with carry forward of loss. It would not be exempt under Section 1038, but it would fall under that exemption limit of 1 lakh, and hence I am not liable for tax on the same. The question arises how to make the computation. 112A goes further. It provides that if there is IFSC even if the STT is not paid, the provisions of this section are applicable. Friends, it is International Financial Service Center, wherein if you are dealing STT, even if not paid, the section 112A is applicable. Central government may by notification in the official gazette may prescribe STT may not be payable on the acquisition, as I have said, 110/2004 या bonus या preferential या public issue वगैरह. The big blow, proviso 1 and proviso 2 to section 48 are not available. Section 48. Section 48 talks about the cost of acquisition, and proviso 1 talks about the buying selling telegraphic transfer rate, and proviso 2 is most fundamental, talks about indexation. Friends, both not available, meaning thereby you are supposed to deduct the actual cost of acquisition only. You cannot deduct any index cost, or you cannot deduct the cost on the basis of the telegraphic transfer. सबसे बड़ा इश्यू, बजट आया, लोगों को लगा कि मैंने 2008 में एक्स लिमिटेड के इक्विटी शेयर्स 100 रुपये में परचेज किए. 31 जनवरी 2018 को इसकी मार्केट वैल्यू थी 800 रुपये. 1 फरवरी 2018 को प्रोविजन लाए कि 1 अप्रैल 2018 के बाद इसको बेचोगे, प्रीवियस ईयर 18-19 में बेचोगे तो आपको एग्जम्पशन नहीं मिलेगा. The assessee would be under tremendous tension that he purchased in the year 2006 at 100. Now if he sells off at 910 rupees, then the difference between 910 and 100 is been taxable 810 rupees. Things will be very problematic. People will rush to stock market in the month of February and March to sell off. Any people rush to stock market, the market falls down like anything. A very smart mechanism by Mr. Jaitley. Friends, I'll be honest, there are only few smart provisions inserted by Mr. Arun Jaitley. This is one of them. He provides cost of acquisition of these shares will be actual cost. In our sum, it is going to be 100 rupees. Or the fair market value on 31st January 2018 or actual sales price, whichever is less, A or B, whichever is higher. My actual cost was 100. My fair market value on 31st January 18 is 800. My sales price is 910. Let's keep 100 in A. In B, FMV is 800. Sales price is 910. 800, 910, whichever is less, 800. Now compare A 100, B 800, whichever is higher will be 800. If I sell off at 910, my capital gain will be 910 less 800. Sir, जो भी गेन मेरा कल तक हुआ है, कल तक का मतलब है बजट आया उसके अगले दिन तक हुआ है, that gain would not be subjected to tax because I am given a benefit of the fair market value on 31st of January 2018. I'll be elaborating this with illustration at length. What is the fun in keeping sales price? Why this FMV on 31st January 18 on the next slides. Friends, chapter 6A deductions are not available from the same. And one most important provision which has been provided here is rebate under section 87A is not available. This is something unique. Even we are claiming rebate from casual income also, but very specifically provided 87A is not available from the 112A tax. Now, if I analyze various situations, I am having date of acquisition, cost of acquisition, 31st January 18, that is a cut-off date, that is a specific date given in the law for taking the fair market value. You are given sale date, you are given sales price, whether the gain is going to be long-term, short-term, and the taxable amount. 15th April 2017, recently you purchased 100 rupee shares, listed equity, I assume. Fair market value on 31st January 18 is 120. It is sold on 4th April 2018. It is sold, mind well, in the previous year 18-19 at 130. Now, if we compare the period of holding from 15th April 2017 to 4th April 2018, can we say it becomes less than 12 months and it would be short term? If it is sold at 130 rupees, it is short-term capital gain. If it is short-term capital gain, 111A is still applicable. Tax rate will be 15%. And in 111A, you are taxable on the sales price and the cost price difference, that is 130 and 110 coming to 30 rupee. Friends, this 30 rupee will be taxable at a rate of 15%. 1 लाख रुपए की एग्जाम्पशन लिमिट इज नॉट अवेलेबल अंडर 111A. पहले रुपए से इसके ऊपर टैक्स लगेगा 15% से. बट इफ 15th April 2017 it is purchased at 100, fair market value on 31st January 2018 is 120. 18th May 2018 it is sold. 15th April to 18th May 2018 it is held for more than 12 months. It becomes long term. It is sold at 133. This will become long term. It becomes long term. Then 112A will be applicable. If we compute 112A, then my capital gain will be sales price 133. Now from this sales price, the peculiar point is I need to arrive at the cost price. For arriving at the cost price, if you just recollect, the formula is A, actual cost. What is actual cost? 100. B, FMV on 31st January 18. What is FMV on 31st January 18? 120 or sales price 133, whichever is less. FMV and sales price compare karo, take whichever is less. 120 and 133, whichever is less will be 120. 120 B में आया, 100 A में आया था, whichever is higher will be 120. Your capital gain will be the difference between 133 and 120, that is 13 rupee. This 13 rupee, if above 1 lakh, then such excess will be taxable at the rate of 10%. Look at the third situation. Third situation talks about this way. 15th April 2017, 100 rupee cost. Market has gone down and your fair market value on 31st January 18 is 90 rupee. 18th May 18 it is sold out at 133. Let us first decide whether you are falling under 111A or 112A. You are falling under 112A because it would be long term, held for more than 12 months. Your sales price is 133. Your capital gain will be computed taking actual cost to be 100. Actual cost to be 100. Or B. B में लेंगे FMV on 31st January 18 90 or sales price 133, whichever is less, that would be 90. If we take 90 compared with the cost 100, we will take whichever is higher 100. My cost deductible will be 100. 133 less 100. My capital gain will be 33. If this 33 exceeds 1 lakh, taxable at the rate of 10%, this excess amount. Next, 15th April 17, 100 rupees share purchased. 110 is the fair market value on 31st January 18. 18th May 18 it is sold off at 107. See the smartness. Here the smartness of finance minister comes. If it is sold at 107, the first peculiar point is it 112A or 111A? 112A, it would be long term. If it is long term, my capital gain will be sales price 107 less the cost price. If we check out with my cost price, A will be 100, B में fair market value on 31st January 18, 110 or sales price 107, 110 or 107, whichever is less will be 107. 100 or 107, whichever is higher will be 107. 107 less 107, it would be nil. And there is no capital gain. Friends, very smart provision for computing the cost. You are not freely allowed the fair market value on 31st January 2018. Assume that if you would have been freely allowed the fair market value on 31st January 18, you purchased at 100, your fair market value on 31st January 18 in our last illustration is 110 and sales price is 107, you sell off at 107. Had the provision of sales price or FMV on 31st January 2018 is not been inserted, whichever is less is not been inserted, you could have got the deduction of 110 and you would have booked the loss of 3 rupees, which is not your actual loss, but which is your notional loss. Mind well, this 31st January 18 fair market value is thoroughly different than 1st April 2001 fair market value applicable in all general cases. There, if my cost price is 100, 1st April 2001 fair market value is 130 and I am selling off the asset at 110, I can book the loss. Here I cannot book the loss. Look at the situation number 4. I am not allowed to book the loss. The reason being, I will be able to get the deduction of the cost worth cost or fair market value on 31st January 18 or actual sales price, whichever is less cost, and B, whichever is higher. So very smart mechanism by Mr. Jaitley. Again, You may have a question that, sir, we won't have the loss. No, you will have the loss. 15th April 17, 100 rupees is the cost. 110 is the fair market value on 31st January 2018. Sale date 18th May 2018, 85 rupees. Question arises, long term, short term, 112A would be applicable. Your sales price is 85, your cost price is 100, or 110 or 85, whichever is less, 85, 100 or 85, whichever is higher is 100. Your capital gain will be 85 less 100, will be giving you 15, negative 15. Sir, last year तक 1038 में long term capital gain exempted था. अगर long term capital gain last year तक exempted था, तो कैपिटल गेन पे टैक्स नहीं भरते थे. अगर लॉस होता था ना, तो लॉस का भी आपको हम सेट ऑफ नहीं देते थे, बिकॉज वन ऑफ द रूल इन द टॉपिक सेट ऑफ इज इफ देयर इज अ गेन which is exempt, the loss from that source cannot allowed to be set off. But as of today, as per proviso 4 to section 1038, long-term capital gain is not exempt. As long-term capital gain is not exempt, the loss would be fully allowed to be set off. In the era of stock market going down in the current year, this provision is not working beneficially for Mr. Arun Jaitley, for the finance minister, for the government. Because the rule is under 112A, if you gain, then that gain is taxable if it is above 1 lakh. But if there is loss, that loss would be set off right from rupee 1. You don't have to see that if there is a loss of 1 lakh, 8,000, then only 8,000 will be set off. No, if there is a loss of 5 rupee, that 5 rupee can also enter into the set off and carry forward of loss, and that is a benefit for the assessee. But let's be, assessee should not make a loss and would not have to go to the carry forward. But if at all he is making the loss and going to the carry forward, he'll be able to carry forward and set off the whole amount. These are certain recent investment. If we check out with old investment, few situations. Again, the same story. We have date of acquisition. We have cost of acquisition. Fair market value on 31st January 2018. Mind well, this is a cut-off date. This is a specific date. Sale date given. Sales price given. Long-term, short-term, taxable amount. Let's check. 25th July 2015, 10 rupees the cost. Fair market value on 31st January 18, 800. 2nd April 18, it is sold at 1250. Is it long-term, short-term? Obviously long-term. If it is long-term, my capital gain will be 1250. Less. Cost की बात करें तो A में 10, B में 800 और 1250, whichever is less. 800, 10 or 800, whichever is higher, 800, 1250 less 800, 450, taxable at the rate of 10% if exceeds 1 lakh. Again, 25th July 5, 10 rupee, 800 rupee is the fair market value. You sold on 31st March 18. If it is sold on 31st March 18, it is sold in the previous year 17-18, you are lucky. If it is sold at 1230, it is long term, and till previous year 17-18, the long term capital gain was exempt under section 1038. You don't have to pay any tax. This has made many people to have a panic situation in the stock market in the month of February and March, and they have started selling, and because of that the market is struggling till today also. 31st January 18, 1230 is the cost, late purchased. See, what I am trying to clarify here is that my client has purchased at 10, fair market value on 31st January 18 was 800, in situation 2 I am talking about, sold on 31st March 18 at 1230, booked the capital gain, but which is exempted under 1038, immediately he purchased the same shares at 1230. सेल किया 31st मार्च 18 को एंड 31st मार्च 18 को ही परचेज किया 1230 में, यही के यही शेयर्स, एंड 2nd अप्रैल 18 को उन्होंने यही के यही शेयर्स 1250 में बेच दिए. देयर वुड बी शॉर्ट टर्म कैपिटल गेन 20 रुपीज. सी, अगर ये रख के बेचता तो 450 रुपये टैक्स आता है एज पर ए. बेचा, फिर से एक्वायर किया एंड फिर से बेच दिया, देन देयर इज अ गेन ऑफ ओनली 20. The difference is that 450 in situation 1 will be taxable at the rate of 10% above 1 lakh. This 20 will be taxable at the rate of 15% right from penny 1. But this may give the benefit to many assessees. Again, 25th July 5, 700. FMV 650. The stock has fallen down. Number of stocks you can see have fallen down. Market has further gone down. 2nd April 18, 580 being long term. Your sales price is 580, your cost is 700, or 650, 580, whichever is less, 580, 700 or 580, whichever is higher, 700, 580 and 700, the difference will be 120, would be able to be set off right from rupee 1. बट यही के यही शेयर्स जिसकी मार्केट वैल्यू डाउन हो रही थी, वो आपने 2 अप्रैल की जगह अगर 580 में 31 मार्च 18 को बेच दिया होता, डोंट सेल इफ यू वुड हैव सोल्ड इन द ईयर 17 18, द लॉन्ग टर्म कैपिटल गेन वाज एग्जम्प्ट अंडर सेक्शन 1038. इफ लॉन्ग टर्म कैपिटल गेन इज एग्जम्प्ट, द लॉस कैन आल्सो नॉट अलाउड टू बी set off. So this provision has come to hit the assessee, but there is a limited hit. We can see in situation 1 of the same table that cost was 10, FMV was 800, difference between 10 and 800 is not tax. Whatever you have gained till yesterday is not been taxed. The balance only is been taxable. So you are taxed on the gain you are making after 31st January 18, but the gain is taxable above 1 lakh at the rate of 10%. The loss would be fully set off right from rupee 1. Friends, the major changes as far as the capital gain is concerned, very, very important from the viewpoint of examination as well as the practicality. Section 193, certain small changes in the TDS. Section 193 talks about TDS on interest on security. As far as TDS on interest on security is concerned, there are certain securities, government securities, on which TDS is not required to be made. But in the list of government security, there are certain exceptions given, that even if it is government security, if falls under exception, TDS is required to be made. There has been one exception added, which provides that government security being 7.75%, taxable bonds 2018, is subjected to TDS at the rate of 10% if the aggregate interest exceeds 10,000. Earlier, it was falling under the exception, no TDS was required to be made. Now, this is been in exception to exception, TDS is required to be made. 194A, a welcome change for senior citizen. Friends, we can see there are number of big corrections, big benefits given to the senior citizen in the particular budget, and this is one of the provision wherein it has been provided that senior citizen earning other interest, FD interest, senior citizen earning interest from post office, cooperative. One thing we have seen, ATTTB, 50,000 रुपये तक जनरल डिडक्शन है, इसको ही मर्ज करने के लिए कहा दैट 50,000 रुपीज़ तक कोई TDS करना नहीं है. मुझे FD का इंटरेस्ट मिलेगा ना, तो 10,000 के ऊपर अगर इंटरेस्ट जाएगा तो टोटल अमाउंट के ऊपर TDS विल बी मेड एट द रेट ऑफ 10%. फॉर सीनियर सिटीजन इन प्लेस ऑफ 10,000 द लिमिट ऑफ TDS इज बीन इंक्रीज टू not 10 but 50,000 rupees under 194A. Certain procedural correction. Permit account number. This particular number is a unique identity of the assessee at Income Tax Department, and on the basis of this permit account number only, government is able to make number of track. You deposit cash in the bank worth more than 50,000 rupees in a single day, bank will give the information to the Income Tax Department and there would be an inquiry to you, रुपए कहाँ से आए. Same way, 25,000 से ज़्यादा का रेस्टोरेंट का बिल पे करो, होटल का बिल पे करो, there is going to be an inquiry. Now, over here, there are certain assessees who are under a compulsion to apply for permanent account number under section 139A. Those assessees are, if you are required to file the return in the financial year, then you have to apply for permanent account number within 2 months of the end of the financial year. If you are not required to file the return, but if your turnover exceeds 5 crore, you are required to apply for permanent account number within 2 months of the end of the financial year. Any other assessee can also apply for permanent account number voluntarily at any time. There has been one compulsion which provides now that every person not being an individual which enters into financial transactions of an amount aggregating to 2,50,000 or more in a financial year is under a compulsion to apply for permanent account number. Specified financial transactions are purchase, sale of debentures, immovable property. If my person is applying for IPO, if my person is, say for example, entering into the purchase sale of immovable property, he is under a compulsion to apply for the permanent account number, so that he has to give the detail of permanent account number. While doing this transaction, the detail will go to department, and department would have a check if it is sale, whether you have booked the gain or not, if it is purchased, what is the source of the money. Second, you people are aware income tax return is to be signed by individual, HUF by Karta, company by managing director, and so on and so forth. If there is a company which has made the application and such application is admitted under IBC 2016, IBC means Insolvency and Bankruptcy Code 2016, then the return of income is to be signed by, return of income of the company shall be verified and signed by insolvency professional appointed by the authority under IBC 2016. The professional who is appointed and who is managing the IBC of the company is also under an obligation to sign the return. And friends, at the same time, you are aware, from certain income there is TDS made. If say for example I want FD interest, from my FD interest worth say 2 lakh rupee, TDS worth 20,000 is made and I am given 1,80,000 net amount. I have to book under that income from other source, grossing up करके 2 lakh as my taxable interest. In my 26A as 20,000 TDS is appearing. But I have not booked this 2 lakh rupee as my taxable income in my ITR. System was been asked under 143(1)(a)(6) to make the correction of incorrect or rather correction of arithmetical error. And system was adding 2 lakh to my return. Now this has become a very big subject matter of controversy because on FD the TDS may be made on due basis. Exceptionally, I am very specific with the word exceptionally, I am booking FD interest on receipt basis. So I have not booked in the year in which TDS is made, but I am going to book it in the year in which my FD matures. If we talk practically, private limited company, I am the auditor. Company is making TDS on due basis on 31st of March 2019 for the financial year 18-19. It's appearing in my 26 years of the financial year 18-19. I am booking the revenue in the previous year 19-20 on the basis of receipt. So there is going to be a mismatch between 26 years and my taxable income of that. It was said, system make a correction and add this amount to Palak. It has been provided from the current year that this type of adjustment are not to be made by the system. Let AO applies his mind and decide. System should not make addition on the basis of TDS made and income not offered to the ITR from assessment year 18-19 onwards. This is, I would say, a good relaxation for various assessees. Friends, these are considered to be your major amendments as far as the intermediate are concerned. I would say, my friends of intermediate, please go through each and every amendment very carefully. It is very expected that institute will test you on the amendments. A very humble request to please refer to the ACCA publication including the revision test paper of Institute of Chartered Accountants of India, which would be very helpful to you, very useful to you. Always understand the provision well, read it at length and write the provision very carefully in the examination. See, it is not compulsion on you to write exact words of the law. May not be. But at least what you write must match with what the provision talks about. With this, wishing you friends very all the best for your examination and hope you will come out with the flying colors.